Welcome to the B.F. Anderson Technical Report on March 31st. Well, when I went to LSU Business School, I learned a great deal. It's a great business school. Dr. Crary was the head of the school, and Willie Stotts, Dr. Stotts, was head of the banking school. But I took one course with Dr. Martin called Statistics, and it was the most fascinating course that I ever took at LSU, and I would say I use what I've learned there today. Now, statistics is nothing more than understanding historical data and trying to extrapolate that data into the future. So it's all about just looking at the past and putting a possibility or a probability on the results. Now, I work with a group out of Salem, Massachusetts. Hold on, let me fix my screen here. And called Cabot Research. For more information, you can go to www.cabot.com. But Cabot was started by a gentleman by the name of Carlton Lutz, who was, in my opinion, an absolute genius. He was a very successful investor. And Carlton had an understudy named Mike Santolo, who I work with today. Now this week, Mike shared with me a study that he had just completed that I thought was quite fascinating. It's called the 7.5% rule. Let me explain. By the way, the 7.5% rule flashed a signal on February 21st, which is this line right here. Now, what the rule is where the S&P 500 on a weekly basis on a Friday close, so you wait till Friday, the close, and if the S&P 500 closes on a Friday 7.5% or more above the 35-week moving average, you get a 7.5% signal. Now, this signal is very rare. It's only happened 10 times since 1980. Happens about every 4 years. Now, another condition of the rule is the signal cannot have flashed in the prior 9 months. And like I've said in many videos in the past, difficult markets and hard markets are usually followed by easier and better markets. The perfect example is the crash of 87. The market lost 30% in one day in October of 87, but by January of 88, we were making all-time new highs, and it was an amazing period. So the 7.5% rule has flashed a signal here on February 21st, and I'm going to show you here in a minute some more information on the last signal. But here's the results of the study. The study says that since 1980, there have been 10 occurrences of this. The following year, the average return for the S&P 500 12 months later was 15.4%, and there were no down years after the signal. The other thing that I think is most fascinating about, and then also it says the following year, the average return was 21%. So the signal is a rare signal, and it's basically saying you're getting a surge of buying here after a prior 9 months of bad market. Now, I think if we digress a minute and go to fundamental analysis, I just don't think it's any coincidence that during the last 9 months, or really the last 3 years, corporate earnings have been declining. Well, here in the first quarter of 17, we've seen corporate earnings turn up in the first quarter, and boom, we get the 7.5% spread. So it's saying that the fundamentals are improving and that the buyers are coming in. So the 12-month return on average 15.4, the following year 21, but here's what's also important. The average pullback, the average correction over the next 12-month period was about an average of 2.5%. Now, there were exceptions. Back in 1990, for example, there was a pullback of 9%, but then it turned right around and went back up again rather rapidly. And so what this means to me is that A, have we launched a multi-year bull market? And B, are the pullbacks not going to be meaningful? Therefore, people that are waiting for the market to pull back to get in are going to be very, very frustrated. So anyway, the 7.5% rule, I think, is a fascinating thing, and I will be monitoring it and sharing it with you in the future. Now, let's look at a correction that occurred back in 2012. You need to understand that there are normal pullbacks and then there are abnormal pullbacks. In other words, there's volatility to respect and there's volatility to ignore, because you're trying to stay the long term. Once you're in a bull market and once you're in an uptrend, you don't want to be jumping around a bunch. So here we have point A, which would be where the market was making a high, and then we got a correction. Here's point B, and this was an inevitable thing that's going to happen because corrections are absolutely necessary. So how could we have dealt with this? Well, if we would have signed here, and I'm just using moving averages again. This is a daily moving average. This is the 100-day moving average, the 200-day moving average, and the 300-day moving average, just to make a point. Notice how the moving averages really stayed steady. So if you look at the price, very uncomfortable. In fact, I'll tell you a story about this in just a second. Now, if we eliminate the price and take the same time period and look at the moving averages only, what the moving averages help us to do is what is right and not what is comfortable. So the slope of the moving averages stayed steady. There was no mixing and crossing. And of course this can change, but looking at these moving averages would have helped you during this period, because if you just looked at the price, it would have been very uncomfortable. Now, here we go. I had a client who came to me during this period. Excuse me for moving around too much. And he had a wife. It was a husband and wife, and they each had separate portfolios. And we got into, this was 2012, and this is the time period that I just referred to. And basically what happened is we got this correction, and as you can see, the moving averages didn't give a sell signal, put it that way. But you got this correction, and the husband, who was very, he has a big opinion on things and very political and would not listen to me, put it that way. And we got this correction, and he pulls out of the market right in here. However, the wife didn't. And so, boom, all of a sudden, we get the crouch, like, Nicholas Darvis said, a dancer sometimes has to crouch before he can leap. So we get the crouch, and then we get the resumption of the uptrend. So to end the story about the husband and wife, we get along here in around 2015, and the wife has done incredibly well. Her portfolio has done very well. And he comes to me and says, I want back in. So this is just kind of a point to be made about human behavior. You've got to use technical analysis and fundamental analysis and keep your opinions out of this, because you're going to miss a move like this. So he did come back in, and we've had to work through this last couple of years. But also, I wanted to point out one of the stocks that we were finding back in this time period, November of 12, was Facebook. So the point there is that when you get into these corrections, the smartest thing to do is look for stocks that are acting strong. So you can see here, Facebook really lifted off here nicely, and that was a sign of strength. Now let's look at a correction where you want to respect this. So this, I'm taking you back to 2016, and you can see here, in the second quarter of 16. These moving averages, now in this particular situation, I'm using the 25-day, the 50-day, and the 70-day. But it doesn't matter, because all the moving averages would have looked this way. So in other words, you're seeing confusion is what you're seeing. And it's just telling you that there's the high probability that bad things are going to happen. Well, sure enough, you can see what happened here. So basically, you would have wanted to be very defensive with your portfolio. You'd probably want to avoid doing any buying and probably raise cash. Now, let's look at the graph with the price. Here's the same time period, and you can see what happened. Boom, we got a real steep drop off in August, rally, but the moving averages just never got into any kind of steady uptrend. And then boom, you got another drop right here at the end of the year, and then things turned up. So let's look at where we are today. So we've gotten the 7.5% buy signal right in this time period, right in here. You can see that there was a lot of confusion here right at the end of the year with the moving averages. But since then, since corporate earnings have turned up, we're now in what I would call a full bore bullish look. This looks like a bull market to me. So if we kind of just take another snapshot of Facebook where we are today, again, it went through a very difficult period here right around the end of the year. But since the new year has begun and corporate earnings have turned up, you can see that with Facebook, the stock's making new highs, the trend is good. So basically, in conclusion, the 7.5% rule is saying we have potentially launched, a multi-year bull market that will have very shallow pullbacks. So for people that are going to say, well, I'm going to wait for the pullback, they're going to be very frustrated. If you have any questions, give me a call. Thank you.